Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Dr. Sei-wan, professor of economics at Ewha Womans University. Professor Kim, good afternoon. Thanks for coming on today.
Good afternoon, Devin.
Well, as we just heard, the minutes from last month's Federal Open Markets Committee show the general view at the Fed is that tapering could start either next month or in December and conclude around the middle of next year. At least as of this meeting, they saw the economic recovery as being on track. What do you make of these minutes from the Fed?
According to the minutes of September FOMC meeting released today, Fed worried that disrupted supply chains were raising the risks of a more persistent inflation. It indicates that inside the Fed, there is a stronger consensus over scaling back the $120 billion in monthly purchases of Treasury and mortgage securities amid the signs that higher inflation. Under plans discussed last month, the Fed would reduce its purchases by $15 billion a month. Fed officials discussed starting the taper in mid-November. If they follow the schedule penciled out last month, purchases would conclude by June next year. This schedule for phasing out the Fed stimulus program is somewhat faster than investors had anticipated just a month ago.
It is, and despite that, stocks on Wall Street were broadly higher on Wednesday as investors weigh the numbers on inflation. Also looking at corporate earnings coming out, the S&P was up 0.3%, and the Nasdaq, with its tech shares, up more than 0.7%. What's the story in the global markets?
As you said, Devin, overall, U.S. market marginally gained in choppy trading Wednesday to snap a three-session losing streak. It looks that traders seem to shrug up hotter than expected inflation reading and confirmation of the Fed's plan to begin reducing its bond buying stimulus program. Dow Jones Industrial Average edged down by 0.1%. The tech-heavy Nasdaq Composite gained by 0.7%. Monetary stimulus, government spending, and effective COVID vaccines have helped power the economy. But lately, concerns over a supply chain problem, rising government bond yield, and rallying oil prices have dented the rising mood. Along with U.S. markets rise, European markets all gained Wednesday between 0.2% and 0.8%. But Asian markets were mixed between Nikkei's 1% and Shanghai's 0.2% gains and Hong Kong's 1.4% retreat.
Today in Korea, though, the rebound in stocks continued, a strength almost across the board. Not so for car makers, though, with the supply chain issues the sector is facing. The Kosdaq was up, too, by more than 3%. Tell us about the domestic market.
Domestic markets advanced today, along with U.S. markets rise yesterday. Also, quite a few encouraging factors gave positive impact on domestic market today, like stabilizing exchange rate, easing U.S. port cargo bottleneck by expanding operation hours, and recovering manufacturing in China. Kospi gained by 1.5%, and Kosdaq also gained by 3.1% today. All large cap stocks advanced today, particularly Samsung Electronics, which suffered from continuous decline, advanced by 0.9% today. Also, thanks to increasing demand for shipping globally, shipping industry had over 9% increase for today.
And Professor, as you mentioned, we've seen some big moves in the exchange rate lately with a strengthening dollar. The won had depreciated to just shy of 1,200 won to the dollar, the highest rate in quite a while, which had led foreign investors to sell Korean stocks. Now the rates come down to under 1190. What's behind that move, and what will be driving the exchange rate going forward?
Until early this week, $1 exchange rate increased up to 1,200 level, which is the highest level in a year. Recently, there are two major factors that made U.S. dollar stronger. The first is higher market interest rate in the U.S., which has a strong power to make people to buy more dollar-based assets. And the second is foreign investor large domestic stock sales in October, foreign investors net sold 2 trillion won in domestic markets. But I have to say that in the long run, over a year or 2 years, there is a strong power to appreciate Korean won or a decreasing $1 exchange rate because Korean economy continues to have a huge current account surplus over 16 straight months. So there will be, I think, more ups and downs in exchange rate for a while.
That's true, and also the relatively low PE ratios here in the Korean stock market compared to the U.S. But Professor, finally, the household debt situation. In September, data show the increase in lending did not slow down at all, despite the government's measures aimed at reining it in. There was a slight decrease in mortgage loans being written, but that was offset by a rise in unsecured loans. What's driving the continued borrowing, and if it is to be reined in, what should be done?
Korean commercial banks' household loans grew at a faster pace in September from a month earlier. The rise in September household loans came despite the government's toughened regulation on lending amid worries that household debt could spiral out of control and undercut economic growth in the long run. According to Bank of Korea, outstanding bank loan to households came over 1,052 trillion won as the end of September. It is up 6.5 trillion won from previous month. This monthly increase is higher than a 6.1 trillion won of August. The reading also marked the second largest month-on-month expansion for September since 2004. This upward trend continued due to the demand for loans for home purchases and jeonse. But I think banks should be carefully controlling jeonse and home purchase loans because there are lots of actual end users in this loan. Instead, the loans to apartment investment and stock investment should be more controlled. And it is, I think, the commercial banks who knows the purpose of each loan. In this respect, there should be more market-friendly regulation on bank loans.
Yeah, we did see some remarks from the government today to keep an eye on those jeonse loans in particular. As you say, end users, there's quite a bit more of those for that particular product. Professor, we'll have to leave it there for today. Thank you, as always, for sharing your insights with us. We appreciate it.
Thank you very much.